Hey everyone, Anthony Perez, certified financial planner with Harvest Wealth Strategies. Today we're going to talk about moving assets from your business to your personal in a very tax efficient way so that you're not having to pay a big chunk of those funds when you go to exit to taxes. So as you look at moving assets from your business to your personal side, just to kind of give you a quick example of what that would look like. Let's say, for example, the business earns $400,000 in profit for the year. There's different strategies that you can use, which we'll talk about today. But let's just say that we're going to use an even number of 70,000. So moving 70,000 not only will give you a tax deduction off that 400,000, but it's also going to allow you to take those funds, put them in your personal name, and allow those to grow over a period of time. Okay, as we talk about different strategies, we are going to start with the smaller companies, work our way up to the larger companies. So if you are a smaller company, let's say you have 100 employees or less, one of the solutions you can start with is a simple IRA. Now, the simple IRA is only going to allow you a certain contribution amount per year, which is $16,000 for 2024, but it's very easy to set up. It allows you to not only contribute the $16,000, but it also gives you the opportunity to have the business either match 3% of your contribution or give you a flat 2%. The only thing with the simple IRA as well is that you do have to contribute. You have to match your employees' contributions or give them the opportunity to contribute to the plan as well. Okay, as we look at the different retirement plans, the first and most common one that you've probably heard of is a SEP IRA. Now, this is extremely beneficial if you are a solo business owner or you have very minimal employees. It's great because it allows you a fairly significant tax deduction for contributing to the SEP IRA, and that's going to be $69,000 or 25% of the business income, whichever is less. And so what you do with the SEP IRA is you can make that contribution that is a tax deduction to the business, and then it allows you to take those funds, very similar to like a traditional IRA for somebody that is a non-business owner, invest those funds and allow it to go tax deferred until you hit that retirement age of 59 and a half. Again, it's a great solution if you are a solopreneur or you have fewer employees. And the reason why is because you do have to match your employees' contribution. So for example, if you are going to contribute the $69,000 max limit, you would then have to contribute the same amount to your employees. So it's a great strategy. It gives you the higher contribution limit, gives you the tax deferral, which is fantastic to allow your money to compound over a period of time. But you do need to make sure that you take a look at not only what your employee base is today, but what you expect it to be going forward in the future. And while you can always change retirement plans, you can start with a SEP and work your way up to some of the different plans that we'll talk about today. It's definitely something that you want to take apart as you plan out your business strategy going forward. Okay, probably one of the most simplest ways to save for retirement, and no secret, it is actually in the name, is a simple IRA. For those of you that are just starting out your business or you have minimal employees, it's a great solution to set up a retirement plan that's very easy to administer. To kind of give you a couple details on what that looks like, it does have one of the lowest contribution percentages. And so for 2024, you can only contribute up to $16,000. However, it's also another plan where you would need to contribute on behalf of your employees. So once again, you want to take a look at the employee base that you currently have today, what you project that to be in the future to determine if this is going to be a proper plan for you. It works the same way that you would have with a SEP IRA in a sense that you would be able to take those funds as a tax deduction to the business and then also move those into your personal name and allow those to grow tax deferred. So once again, very great solution if you're looking for something super simple and that you want to start moving some of those assets early on when you're starting to see that business grow. Okay, so if you're looking for flexibility, a 401k plan is a great solution. Now, 401k plan, many of you have probably heard of this. It's a plan that's very commonly offered to those of you that might be W-2 earners or working for a company today, but it's also a powerful and flexible way for you as a business owner to start moving those funds from the business to your personal name. How it works is very similar to what you've seen, again, for W-2 employees at organizations, but we're going to talk about how this is beneficial to you as the business owner. So the same contribution limits apply, which are $69,000 per year. If you are over 50 years old, you do have a catch up of $7,750. So essentially, you're able to contribute just over $75,000 per year. The reason why this is a great option when it comes to flexibility is you can actually tie any type of matching contributions to your employees to the performance of the business. So it allows your employees to have engagement not only on the fact that they would be able to get and be eligible for matching contributions, but it also can depend on the performance of the business determines what that match would look like. Very good plan, very flexible plan, and it can be a very powerful way for you to max out each year, pulling funds from the business into your personal name. All right, so we're escalating our way up to the higher level plans that allow you to make significant contributions. We're going to talk about a defined benefit plan. Now, a defined benefit plan is essentially a personal pension plan for you. It's a phenomenal tool if you are looking at exiting your business within that 5 to 10 year time frame. What this allows you to do is it allows you to make significant contributions that are both based on your age as well as your income. And so in a lot of cases, if this is structured properly, you're contributing or have the ability to contributing upwards of into the six figures. Now, there are some things that you want to make sure that you're capable of doing by setting up this plan. One of them is making long-term contributions. The other is that you will need an actuarial calculation to make sure that you are making the proper contributions each year. And so those two areas are areas that you want to look at to determine whether or not this is going to be the right fit for you, but it is going to be one of the most powerful plans in terms of the contributions that you're able to make to start moving money out of the business into your personal name. For those of you that are real estate owners, and when I say real estate owners, you own property that maybe your business operates out of or operates in. Another great way for you to start siphoning money off to you personally is to act in the capacity of the landlord for the property. In essence, the business would pay you personally for the rent. Now, it has to be fair market value rent because, again, you're going to have to pay taxes on that rental income that you receive. However, in some cases, you actually may be able to qualify for the QBI deduction, which could be up to 20% of that income. It's a great solution, once again, to start pulling money out of the business and starting to pull it into your name so you're able to build up that nest egg outside of the business assets. For those of you that already have an S Corp, you may or may not know that that's one of the best structures from a tax perspective to set up. And very simply put, as the business owner, you can pay yourself a reasonable salary. Once again, per IRS guidelines, it has to be fair market. It can't be you're paying yourself a super low dollar amount. And then the rest of it you can take as a distribution from the business. The reason why this is such a great tax efficient way to go is that you avoid paying the 15.3% employment tax. And so as you look at whatever that salary is, let's say it's $100,000, you are paying that 15.3% tax on that, but the rest of it that you're getting as a distribution, you're going to be paying capital gains tax on that, which in some cases is going to be anywhere between 10 to 20%. Most cases, you're looking at probably 15% based on the current brackets that we have for capital gains. So it's another great way to be tax efficient in terms of how you're structuring your compensation. Okay, this is one of my favorite strategies. I've actually implemented it with my businesses, and that's paying your kids through the business. You actually have the ability, as long as it's a fair job and that they are producing in terms of work, you have the ability to pay your kids. Now, under the current tax law, they can actually earn up to $14,600 tax-free. So whatever you pay them under that amount, they're not on an individual basis paying taxes. It also allows you to once again get a deduction from your business for whatever you're going to pay them. So it's a great way not only to start, call it building a nest egg for your kids, helping the business out, but it's also a great financial literacy opportunity. For me and my son, as part of my auto detail business, he's helped out over this summer doing some work for me, I'm able to pay him out of the business. He's able to earn a little bit of extra cash that he can do with what he wants. And at the same time, it's a great tax efficient way to pay less taxes from a business standpoint. Okay, another option that you can use to start moving money out of the business is your standard gifts. Now, gifts in terms of what you're doing here is you are providing a gift to someone other than yourself. The current limits are up to $18,000 per year that you can gift without tapping into your exemption. If you are married, you can double that, and that's per individual. So you could actually contribute this up to 10, 15, 20 people. And it allows you to start moving money out of your estate so that when you come to the point where at passing, you're going to put yourself in a very good position from an estate planning situation. However, you have to make sure that, once you make these contributions, they're no longer your funds. So they are the funds of the individual that you've given them to. So you want to make sure that you think that through. Now, this isn't necessarily a strategy that's going to help you save from a perspective of your individual. But one great strategy, and we've talked about this on another video, is gifting shares of your business. So if structured properly, you can gift shares of the business up to that amount, that $18,000 amount, to start shifting some of those assets to, let's say, your kids now. That will grow over time. And that's a great strategy that you can use to be able to accomplish that.